Hey guys, what's up? Felipe here. Welcome to my channel. Currently focused diversity, which is my partnership fund name. I think it's pretty cool. So let me know what you think on that. So let's get to it. This video is just an update on the market, kind of my analysis on the market and my research in terms of, in my opinion, what I believe is going on. And it's kind of scary. We have the dollar increasing in value, so the DXY index, right? On the other hand, we had commodities rallying to an all-time high, or not an all-time high, but a multi-year all-time high. All commodities, for example, from agricultural to energy to metals to you name it, they've been exploding, right? Based off of the conflict in Russia and Ukraine and other, subtle aspects going on around the world. For example, certain countries, banning exports of certain commodities such as soybean and etc. So Federal Reserve has made it clear, although people believe that, they're not going to push rates up so dramatically. However, historically, back in, let's say, 1930s or so, they did the same, right? In reality, there's really no way of pointing out the catalyst that popped the bubble in the 1930s, the Great Depression, right? However, at that time, the Federal Reserve did the same thing. They began a monetary tightening, and they began reverse quantitative easing, which is tightening, and they began increasing rates. As we're seeing now, today, at this time, basically, the Federal Reserve is increasing rates, and capital outflow from bonds and equities are increasing. For example, investors and liquidity investors are exiting the market because of lack of uncertainty. Every time capital inflow increases, it's a very bad sign in terms for equity markets. And it's a very bad sign if it's both equity markets and the bond market, because the bond market is all. Bond market is the foundation to everything. We're seeing these high-flying stocks freaking plummet. I mean, a lot of them are still overvalued, in my opinion. For example, one that I've been doing research in, Papa John's. Its PE ratio is 900 something. That is absolutely ridiculous. And based off of, my analysis of going through their financial statements and all that, nearly nothing justifies that price. And it's amazing to me that these companies are doing share buybacks at these crazy values as well, because I believe Papa John's has like forget how many millions of they have a program to repurchase their shares back at market or at their discretion, and they've been doing so at like crazy prices, $120 a share or whatnot, when that company is not worth that, in my opinion. And it's specifically now, although we're currently seeing certain food industry companies such as Coca-Cola and whatever, reporting really good earnings because they have a lot of inventory at hand, for example, or their operating costs are very minimal. Coca-Cola, for the most part, I'm not super familiar with how, their product works because I personally don't drink it. It's basically water, sugar, and some other ingredients. So it's not, extremely expensive inventory to, obtain to produce their products. However, certain food industry restaurants, such as, I believe, personally, in my opinion, Papa John's, Texas Roadhouse, etc., they have to pay employee higher wages based off of inflation. They have to pay higher prices for their products to create whatever food items they are selling to the customer. So as we have seen recently, wheat, cheese, you name it, all kinds of agricultural products and commodities have gone up tremendously. That is going to affect the restaurant business. Why? Because they have to now pay more for, the commodities that they use to create their products to sell to the customer, client. However, the caveat to that is that for the most part, they pass on those prices on to the consumer. But at what point the consumer is going to be like, no, I'm not paying these prices for this. Why? This is ridiculous. So in my opinion, in the near future, possibly not during this quarter, the restaurant business is going to get hit pretty hard based on the fact if agricultural products and commodities stay at the current prices they are, which is pretty extreme. On the other hand, you have the Federal Reserve pushing up the rates to tame inflation. So they're trying to bring all these prices down, such as energy, which I feel energy is going to crash. I'm looking for the right time to start shorting energy, which I'm looking at the charts now, for example, WTI. And I mean, you can never predict the charts, but it gives you a reasonable idea of where to start looking and, where to place your bets. It's just another additional strategy that I use, fundamentals, technical analysis, all this kind of good stuff. It's a nice combination, although people, they do say, oh, technical analysis like palm reading, but in fair occasions, it is pretty reasonable to trust. For example, look at all the major indices in the United States: S&P, NASDAQ, HGX, the housing index. They've all had a death cross, meaning the long-term moving averages have been crossed downward by the short-term moving averages. Typically, long-term moving average is the 200-day moving average. Intermediate moving average is 50-day. Short-term moving average would be between 10 to 21 days. They have all crossed under the 200-day moving average, signifying a death cross. Every time that has typically happened, it's been a bad sign. Of course, there's been false signals of it in the past, but for the most part, it's been a pretty reliable sign of, the market heading into a downturn, or the major trend is currently downward. Additionally to that, just the evidence is piling up. The short-term rates are currently just about higher than long-term rates, meaning that the yield curve is practically flat. The Federal Reserve is advising that they're going to continue raising rates, which typically the rates that they raise for the most part are short-term rates, long-term rates, etc. But short-term rates typically go higher than long-term rates, meaning the yield curve will inverse, kind of almost like the same situation where the moving averages cross under, boom. So short-term rate crosses the other way around, actually inverse. Short-term rates go higher, the yields, than the long-term rates. So short-term yields, therefore, are then higher than long-term treasury bond yields. Inverse curve. Inverse yield curve. That's another sign. Additionally to that, so we have inverse yield curve, we have death crosses on all the major indexes, we have the dollar increasing in strength, as if you can look at the DXY index. You have the housing index, which is the HGX, which is basically a combination of many housing related sectors within the economy, such as builders and etc. are in the major trend is down, although they're rallying, because downturns have reactions, and those reactions would be rallies. I think those are the minor trends, and the major trends for the major indexes are downtrends. You're seeing these crazy freaking 30% drops on major companies such as Netflix, Facebook, within days. Boom, it just drops off a cliff. And I personally believe, in my opinion, you know, the market is in really big trouble in the near term, possibly intermediate term. And I would be freaking amazed if we don't have a major recession by the end of this year. It's clear, all the signs are around you, as I just mentioned before. But then again, that's my opinion personally, and that's where I'm putting my money. I have gone from, you know, going long. Of course, I have my long-term investments, but I'm talking about now trading and speculating. I've gone from going long to now looking into shorting certain individual indices or companies or whatnot, which one that I'm looking into very heavily is Papa John's and energy, because I believe energy is going to crash. There's no way energy can maintain these high levels while they're hiking rates and the dollar is increasing. It just doesn't make any sense. It's either as they've said, or as been in the past, a situation where the dollar and commodities are at par, increasing at the same time. It could be extremely bullish for commodities, but in my opinion, I feel like commodities have to crash, because if the dollar is going up, one of the two has to drop. They don't correlate. They're usually inverse. Dollar goes up, commodities come down. Commodities go up, dollar comes down. Purchasing power of the dollar comes down. But that is my opinion personally, and kind of my analysis of the market and seeing what's going on. Give me your opinion, your comments. I'm curious. You know, I always like to see other people's perspectives, because at the end of the day, it's wild. It's a very complex situation, and the best we can do, you know, is do our research and let the research guide us, right? All right, guys, thank you for popping up, and if anything I say is of any value to you, hit me with a like and a subscribe, and I'll talk to you guys soon.